Good news, the panel made it. We're all here, clear-eyed today. Hey, Seth. Good morning. All right, good morning, everyone. It's great to be here. Feel the energy in the room thanks to yesterday's great events and Michael kicking it off with his high energy this morning. So hopefully we continue that here. So I am Dustin Courtier from Step Zero. The names and faces on this stage are very recognizable, but as they introduce themselves, what I want you to listen to is they're introducing themselves perhaps in a way that you don't know them. So in a way that they have experience in the merger and the acquisition space, and that's what our topic is today. So Seth?
Morning. Thank you, Dustin. Thank you, CJI, for having me. Really glad to be here. Seth Slotkin, 5x5 Trading. From an M&A perspective, my first, so I've been in the business 18 years. My first M&A experience in the business was about 15 years ago. The company I was at was called Marquis Jet, which was acquired by NetJets. A few years later, myself and one of my partners co-founded and launched NetJet's whole aircraft brokerage business. And when we did that, we eventually commercially launched that as QS Partners, which also QS Partners eventually acquired an additional aircraft brokerage to help us in our growth plans. In 2020, we stood up and launched Wheels Up Aircraft Sales as a business unit under Wheels Up, which we eventually did a corporate spin-out this January the 1st to launch the company 5x5 Trading. So I look forward to discussing everything with all you guys. Thank you.
Morning, everybody. I'm Chad Anderson. I'm the CEO of Jetcraft. And as M&A is concerned, our first acquisition was in 2013, back when Jetcraft was really on its growth path on a global stage. And we acquired the ExecuJet aircraft trading team out of Zurich, which really took our company growth plans that were originally intended to occur over 3 to 5 years, and we bulked it all into 1 year. That team we absorbed, took underneath the Jetcraft brand, and continued to march on as we grew organically. More recently, in April of 2023, we closed on our acquisition of CFS Jets, which strategically for us was our endeavor to actually go smaller in terms of aircraft strengths and bring it back home to the Americas, because CFS was very focused in the Americas. So it kind of is helping round out our strategy around the globe to make sure we're ever present in the US, Canada, Mexico, et cetera, as well as the rest of the world. So we're currently on a path of acquiring a business once every 10 years, but we hope to improve on that.
Hi, I'm Ramsey Amar. I'm the managing partner at BizJet Law. We're a boutique aviation law firm specializing in aircraft transactions, tax planning, and aviation M&A. I actually started my career in the corporate and M&A department of an AmLaw 100 firm, where most of the deals we worked on were 50 to 100 million middle market deals, and both the buy side and the sell side. During the early part of my career, I helped stand up the aviation practice of that AmLaw 100 firm, and we started focusing more on aircraft transactions and aviation M&A. So about 6 years ago, we spun out and started BizJet Law. We focus most of the deal work on airplane deals and deals in the aviation space, so 135s, 145s, 133s, management companies. If it touches the aviation space, we've probably helped buy or sell it. Right now, we do probably one M&A deal for every 3 to 4 airplane deals that we do. The majority of the deals that we do, we act as outside counsel, but we've also had the opportunity to go through an exit from the inside. So about 10 years ago, we had helped one of our clients sell his aerospace company for $20 million. He took a lot of that money and rolled it into another one. We helped him sell that one. And then about 4 or 5 years ago, he approached us and said, hey, I appreciate your business acumen. I want you to partner with me, and let's go on another ride together. And so We partnered with our client. We helped roll up 3 companies and eventually exited to a private equity buyer. So it was enlightening for me, having all the experience on the outside counsel perspective, to be on the inside of an exit as well. And the last thing I'll say is I think each one of these guys on stage has a very unique and dynamic perspective. And I think each one of us have a different angle to bring to this. So it should make for a pretty exciting panel.
Let's hope. Lots of good experience on stage. As I mentioned, I'm Dustin Courtier with Step Zero. I am a certified exit planning advisor from the Exit Planning Institute. So I help business owners identify their options and really plan for when the next stage in their careers, in their lives. My practical experience in the industry, when I was managing partner at Jetaviva, we merged with Kansas Aircraft, and a couple years later we acquired JetQuest. So, and what's interesting about that is we were not massive. We were a team of 5 when we did our first merger, and we were able to grow to eventually we got to a point where we were volume-wise one of the largest transactors of turbine aircraft in the world. So, all right, so this is a topic, it's about brokerage M&A is what the title is, but really it's relevant to the majority of people in the room. And why people should care? Well, everybody's career is going to come to an end at some time. As a business owner, as a leadership team member, at some point, you know, that dash of our career comes to an end. And the statistics are pretty sobering for what's coming for people that are looking to exit from their business, okay? So in the macro environment, even beyond aviation, over the next 10 years, we're looking at approximately 180,000 to 200,000 businesses exiting per year. So that's annually. If you look at how they exit, typically through a business broker on the lower end or through private equity, business brokers are 7,000 to 10,000 transactions a year. Private equity is typically around 3,000. So you're looking at 12 to 13,000 successful exits with almost 200,000 companies trying to exit annually. So the statistics there are pretty daunting if you're trying to be successful. So let's look at some more. So 80% of small businesses end up unsaleable. There's nothing to buy. 50% of businesses exits are involuntary. In other words, they're forced to exit before they're ready. And this one's pretty interesting. 75% of owners, and Ken Rickey mentioned this yesterday, right? He regrets selling everything. 75% of owners who are successful in selling regret that within 24 months. And as you can probably tell already, planning for an exit is very important, yet 79% of business owners have no written plan for transition. So just a little bit deeper on why 50% of exits are involuntary, we call the 5 Ds. So we have death, disability, divorce, disagreement. Anybody here in a partnership with a business starts out great, but over time that partnership can experience some disagreement, and then distress, right? So the macro economy basically says, hey, there's no longer a market for your business. So with those kind of sobering statistics, let's tap into some of the expertise on stage. And Chad, I'd like to start with you in terms of, more stats here. One more stat. Okay. Why don't they sell? 55% say it's because the owner thinks their business is worth more than it is, right? And not a surprise. Owners put their blood, sweat, tears, hearts, everything into their business. It's not a surprise they think it's worth more than what the math says. What may be a surprise is how many 11th hour events happen where the owner says, I'm just not ready to sell. And owners' identities are tied into their businesses. So to go on to the next phase in life, out on the golf course, wherever they decide to go, is a daunting task. 4% say the terms are totally unreasonable, and about 20% don't make it through diligence. Okay, so now on to Chad. What drives value? So if somebody's going to be successful, and you've had a couple of successful acquisitions, what drives value in the business?
When we've explored the acquisitions in the past, there's three primary factors that we're going to look for: is credibility. Does the company have a culture that is manageable and complementary to ours? And do they have a complementary business model? Those are kind of the 3 C's that we look for. You know what I didn't mention there? Financials. I didn't. Because if you have the first 3 C's, the financials will follow. The reality of the who you're looking for and who you're talking to is very likely going to be your neighbor in this room. And oftentimes in our history of discussions and or acquisitions we've done, it's always been companies or individuals that we've transacted with over decades. So the underwriting is very unsophisticated.
So I've heard it described before, especially in terms of the brokerages and merging brokerages. It's like getting 3 scoops of vanilla. There's no real synergy that's built. So as an acquirer, what are you actually buying?
This might appear in the CJI Weekly, so everybody ready to take notes? Very sophisticated. You're buying people and data. That's what you're buying. And the people in the company have a network, they have professionalism, they have established deal acumen, and somebody that we feel would be a natural fit. The data, all of us rely on data to fulfill our mission. First question we all get as aircraft resellers: what's my airplane worth, right? So it's very, very, very sophisticated. People and data, that's what you're buying. So how do you underwrite that? Decades of experience.
Thanks. Well, that was really, it was interesting to see the least amount of emphasis was on the financials for the company. And so in Chad's 3 C's there, he really emphasized the intangibles of the business. And in those intangibles, you have people, right? In the human capital, the data considers the customer capital. What's the spread of the customer base? The social capital is how is the company recognized in the industry? And is their culture tangible? Is it palpable when you talk to people within the company? And then finally, the structural capital of the business really has to do with the processes of the business. Are the processes wired? So, and since we all like pictures, since we're in aviation, your financial results of the business are typically only 20% of the value equation. Those intangibles that Chad mentioned are 80% or more of the value of the company. So, Ramsey, you've led a team of successful exits before. When should somebody get involved with your team?
Sure. Do you mind actually going back a few slides to your 5 Ds here? Okay. So when you think about engaging a lawyer, I want to differentiate here between what I'm going to call Main Street M&A or a Main Street exit and a Wall Street exit. So when you think about a Main Street exit, the majority of the ways that equity is going to get transferred on a cap table in a small to middle market company probably revolves in one of these scenarios. And I think we're looking at involuntary exits here, but if you were to add voluntary exits or equity transfers, I think you would think about retirement, you would think about bringing on a partner or employee stock incentive plans that you might put in place. And so I think that type of activity is what makes up the majority of equity transfers in the space. And so when you want to engage an attorney is whenever you're thinking about how that equity, you're going to set it up in the first place, or you're going to transfer it over time. So when you think about the various corporate mechanisms that you can put in place in your governance documents, you should think first, should I have a sole shareholder here, and this is going to be an eat what you kill model, or are we going to share equity, maybe 50-50 or 51-49? Maybe the comp over time might be similar, but there are tax reasons why you would want to structure it one way or another. There are additional corporate mechanisms that you put in place. If you have a sole shareholder in place, then that sole shareholder is going to be the one that dictates if you exit, if the company sells, et cetera. But let's say you have numerous partners. There are definitely provisions that you want to think about in your corporate governance documents, like drag-along rights, where it gives the majority shareholder an opportunity to drag along the minority shareholders and require them to participate on the same terms that the majority shareholder is signing up for. There are complementary tag-along rights, which permit the minority shareholders to participate on the same terms that the majority shareholder is selling for. There are rights of first refusal, where if, let's say, the majority shareholder wants to exit and they want to sell to a third party and they sign a deal up, a right of first refusal or a ROFR would permit that minority shareholder to buy the rest of the company on the same terms that they're selling for. Something else I think that perhaps is relevant, because I think you see a lot of companies in the aviation space where you're passing down the company to your son or your daughter, is what's called cross-purchase redemption provisions, where it would be backed by keyman insurance. So let's say you have 50-50 shareholders in a company and one of them dies. What happens in that instance? So what happens if you have these types of provisions in place is you would have the company or the remaining shareholder would come into those proceeds of insurance, and they would be required to buy out the remaining share or the deceased shareholder, and it provides for a smoother exit. We're actually in a litigation right now where we represent the shareholder who his partner ended up dying, and the heirs came into that interest, and there's a disagreement about how they can participate, about the value of the company whenever they go to whenever the remaining shareholder tried to buy him out. So we have to, on the back end, spend a lot of money in legal fees to agree on how the heirs are going to exit from the business. So start early, plan ahead. That's sort of the more closely held types of transfers. But when, let's say you decide you want to sell, I think you want to start thinking about engaging legal and finance probably 2 to 3 years in advance. And on the legal side, one of the reasons that a deal can take so long is the due diligence process. So when a buyer starts digging into all of the skeletons in the closet, so you want to engage legal 2 to 3 years in advance so we can help set up the VDR, the virtual data room, where we're uncovering what are those skeletons and how do you best position those skeletons when a buyer is going to uncover them. And then on the finance side, again, you want to engage those people, whether it's somebody like Dustin as a certified exit planner or a broker or an investment banker. Normally, when you go to exit, the buyer is going to ask for 2 to 3 years of financials. So they're going to take, let's say they take 3 years of financials. They're going to figure out what your EBITDA number is. They're going to multiply that by a multiplier based on whatever industry that you're in. And they're going to say, that's the value of your company. So if you have somebody that's able to guide you through the last 3 years of your business, you want those numbers to look like, you don't want to be up, then down, then up again, because they're going to say, okay, let's take an average. You want that. Whenever you exit, you want it to look like you're on a rocket ship, so you have more leverage to negotiate to say, yeah, this value is continuing to move upwards. So I think it's so cool, Dustin, what you're doing in the space, because Dustin, I think, is serving a gap where most of the time people engage legal or an investment banker, hey, I'm ready to sell. Okay, what do you got? Here in the last 3 years, where somebody like Dustin, who can really turn your company into a lean, mean fighting machine throughout the process and help you think about how you're going to exit on that upward trajectory, I think is really serving a gap in the market.
Do you prefer Venmo or Zelle? So, so lots to think about, right? Just what a business owner needs on his or her plate is more work, right? So when you're in the trenches day to day, oftentimes it's challenging to get outside of that box and look at the business from the way that a board of advisors or an investor would look at that business. But you know, when you look at what Ramsey's team goes through, you realize how much more prepared and how many more options you could have as you take the time to do that. Seth, you had a great experience at QS, and you had to make a choice in growing that business. Do you grow organically, or do you gobble another? I had to throw a Thanksgiving reference in there. So, do you gobble another company to grow? How did you make that choice, and what did you make?
That's a good question. So it was kind of interesting, I guess, because at the time, we did the seemingly Herculean task of launching QS Partners, getting NetJets and Berkshire Hathaway comfortable with this concept of launching a whole aircraft brokerage inside of the largest dominant fractional provider in the space. So, we were the little engine and things were going pretty well, but I think the realization we came to, which is I think where your question is going, is that we needed to grow faster and we needed to grow on a larger scale. And there was a lot of pluses and minuses to going either way, and we ended up deciding to go the acquisition route. We acquired a firm called Seratani Aviation, and a lot of it, I think, stands at the root of what some of the great things about our industry. Before I was in aviation, I was more in the tech world, and in the aviation industry, you have what we all like to call cooperation, and you tend to learn. I think as Chad said it well before, you tend to learn a lot just from doing deals with people and being in the ecosystem that we're at, whether it's through OEMs, through other brokers, through other folks in the space that you work with. And we had found a partner that would help us grow with some stuff that was obvious, but some stuff that also were intangibles. And I think some of the things that were talked about, I don't have as much. I don't have any C's or D's or anything else to give you guys, but like the scenario for me was we had complementary skill sets which fit perfectly in order to grow, but also we had this massive cultural fit. And the cultural fit was very important because our largest and really most important shareholder had a large business that they were trying to protect. And if we grew too slowly, we would fail the mission. If we grew too quickly by taking on an acquisition that wouldn't work, we would also fail the mission. So in this case, we had what ended up being the perfect group to acquire. And philosophically, I sit probably more in the Charlie Munger camp of let's grab a great business and pay a fair price for it, and then the success will come, versus trying to do things on the cheap and then seeing how that works out. So it ended up being a very good story.
Great. So Chad, lessons learned in terms of the acquisitions you've been through. What, as you kind of went through a debrief of the situation, what do you think worked? What doesn't work? And what would you share lessons wise?
Okay, we didn't brief on that question, Dustin, but
You didn't read your brief.
I'm actually reading some of the fun questions you guys
All
are
right.
posting, but I'm going to answer the question. I mean, some of the lessons learned for us, and the most recent acquisition was when we acquired CFS, and we went back and forth in the process on whether or not we would merge them underneath the Jetcraft umbrella and just all do business as Jetcraft. And Mitch and Dave and myself and Peter were, sitting at a restaurant one night and saying, heck with it. CFS, you're doing a great job. You're good in your market space. Continue to carry on and do what you do. And the lesson learned in that so far, that was a good call. And as much as we want to grow the brand of Jetcraft and improve on the brand of Jetcraft, that's our ultimate goal. Let's let our partners do what they do. The other lesson I learned is from our acquisition, I don't really want to, looking back in time, you can look back in time 3 to 5 years and look at their financial results, but I'm looking 3 to 5 years down the road. And we're not interested in being a retirement plan. It is an exit strategy, but if it isn't, here's our math. 1 + 1 has to equal 3. If we can logically say 1 + 1 = 3, then it's going to make sense for them, and it's going to make sense for us. In that process, as we're looking at other companies, we spend as much time evaluating what value we're going to bring to them. Because if we can't answer that question specifically, it's not a good acquisition.
That's great. It's great. I know just from our experience in our first merger, we looked at a company. We were primarily in the light jet space, known for that, and we looked at a company that was very heavy in high performance piston and turboprop. So we were buying, along with the people in the data, we were buying a lead source for us, a feeder source, and that's how it gets to the 1 + 1 = 3. If both companies specialize in super midsize, it's hard to make the math work that it's anything more than you're buying a few salespeople, right? Now, Seth, you have a really unique experience in terms of your history with public companies. So in your Wheels Up experience, you were building a company up that was going public and then ended up divesting it afterwards, right? So take me through some of the lessons in that and some of the obstacles or challenges you were facing in that scenario.
Okay. Another unique situation, and that's, these are all like a snowflake, I suppose, but in the Wheels Up scenario, we were hired to stand up a Wheels Up aircraft sales, a whole aircraft sales and acquisitions business, of which we did in 2020. Initially, the idea was, on one of the conversations were, is that a separate company, or is that a company that folds underneath Wheels Up proper? With Wheels Up's intent at the time to go public, we ended up just folding in as being a business unit, and it was and has been an excellent partnership from day one. Some of the characters have changed, but it's an amazing partnership amongst companies. The two things that existed at the time as we were trying to go public that Wheels Up wanted us to focus on was, number one, how do we support the objective to be the Amazon of private aviation, right? How do we help focus on supporting that ecosystem, focusing on everything that they were trying to provide to the market, the story that was going there. And some levels we were the finishing piece, and other levels we were just additive to that ecosystem, which gave them additional horsepower towards the IPO, which happened for all of us on July of 2021. As time gone on, one of the other piece that was a focal point was building up one of the world's best retail brokerages. And so over time, I think what we came to discover was we spent a lot of time on the first piece and spent probably a little bit less time on the second piece. And so as we had a great 4 years together, and what the mutual decision was, we did all these good things. We want to continue to do good things together in the future, but if we want to make sure that both of our objectives are met, we need a strong retail brokerage format. That's going to help both us and Wheels Up be most successful in the future. So we did a corporate spin out on January 1st to become 5x5 Trading. And we continue to do all of the things that we did in the past. Wheels Up is now our largest client, has been a great supporter and ecosystem for us. And now we continue to go out and invest in building the brand of 5x5 and helping and working, within the great ecosystem we have here in the brokerage space.
So just to follow up on that, if there are companies out there that are building a vertical and they want to add a retail broker onto that piece, what were there any limitations or obstacles that you found working with public entities that, as a private broker, you don't have that limitation?
You find some limitations, but it's like everything else that I think everybody's spoken about. It's who you decide to dance with, right? And if you choose a partner that is a really good mutual fit and everybody understands and has clarity about the expectations, I think the limitations are mitigated. And in fact, I would, and again, I'm an optimist by nature, but I think the way you'd see it is anything that a public company could provide could actually be significantly additive. And that's really what we found. And certainly you have to think about things like corporate governance, and sometimes you have to focus on the primary part where it's like, how do we help the ecosystem be successful because the company's going to go public or is public? So those are important things to consider, but I think if done correctly, I think the limitations are minimal.
Thanks. Ramsey, what is critical to consider when you're choosing that dance partner from your point of view, from the legal point of view?
Are we talking about towards an exit publicly or just?
So in any kind of merger, or whether you're the buyer or the seller and you're determining whether this company is a good fit for us to partner with, what are the aspects from the legal point of view that you should be considering?
Yeah, so I think whenever you're thinking about selling, there are two different buyers that you're going to sell to. You're either going to sell to a strategic buyer, or you're going to sell to a financial or a private equity buyer. And going through that process, if you're selling to a strategic buyer, that's going to look a little bit different than you would to a private equity buyer. So on the strategic side, if we're purely talking about the aircraft brokerage space, it's probably likely that the buyer in a purely aircraft brokerage firm, the buyer is most likely going to be another aircraft broker in this room. If you have other companies bolted on to that aircraft brokerage, so maybe it's a management company or 135 or 145, I think you're going to have more options with who to dance with on the exit, because private equity players get more involved in that space, in my experience, in purchasing and trying to roll up multiple of those entities so that they can trade it again in 4 to 7 years than it is to actually buy a purely aircraft brokerage.
So just follow up, just to incorporate some of the questions that we're getting, Ramsey, on that. What would you say maximum number of years you'd recommend having earnouts exist?
It depends. If I'm on the sell side, I don't want an earnout. If I'm on the sell side, I want as much cash in my pocket whenever I sell as I can. If I'm on the buy side, I probably want to string that out. So when you think about, you had a slide on here where the majority of business don't sell because there's a difference in valuation. I think you want to think about, in the aircraft space, you're normally just trading cash for an airplane and you're moving on. In a company sale, there are numerous ways that you can structure that consideration for the company sale that can help bridge this gap that you're seeing. So for example, you might think about cash. You might think about seller financing in the form of a promissory note. There might be earnouts or escrow holdbacks. There might be equity rollover where you trade some of your company for equity in the other company. So there are ways to bridge this gap that I agree, that's probably the top reason, but I think if you have a good team in place, they're able to help structure what that purchase price can look like. So the answer to the question is, it depends who I'm representing.
I love it. I love it. I just want to add on to that in terms of the structural capital. So if you as a seller want to minimize your earnout time, don't be involved in your business, right? Get the structure, get the processes in place so that your revenue that you're bringing into the business is less than 10%, right? I mean, how many business owners in the room, especially in the brokerage space, the revenue they bring to the business is 80% of the business's revenue. Chad's already said it. An acquirer is not looking to be your retirement fund, right? So if you strip 80% of your revenue out of the business because you're heading off into the sunset, that's going to be a pretty long earnout. So, having a professional sales team, having a sales manager, having the pieces in place where the revenue of the company is not dependent on your rainmaking, that's how you'll minimize the time of the earnout. All right, let's take another question up here. Well, this is kind of the interesting one, and it goes in line with like who's got the checkbook, right? Who's got a checkbook right now that's looking, and there's a question on here about a traditional roll-up. So, Chad, you mentioned at breakfast just about, and just talk about the volumes that the professional investors want to see and how that may apply in our space.
Yeah, what he's referring to is most of our companies are relatively small companies, Jack Craft included. Under companies, generally speaking, undervalued, underneath, whatever, $100 million or whatever you want to call it, $50 million. We have maybe this many interested other non-industry buyers. But if your company is worth $500 million or $1 billion, your pool of buyers is far bigger. So the biggest problem we have as an industry for attracting other investors for our respective companies is we're almost too small. So this is a really good slide, and this is a good one if you want to look at it, is just saying the class of buyers that we would have available. You have an entrepreneur, let's say a guy who's a pilot, loves the industry, just wants a business in aviation, you might get lucky. But they're also going to be financially careful. Then you have the industry buyers. All of us in this room are industry buyers. Then you talk about professional investors or strategic buyers. Those are the buyers that are private equity. They're going to care 80% about your past results, 20% about the rest of it. So it's going to be the reverse. And as Dustin said, the concentration of the business and who the business generators are is going to, they study very carefully. So it's what you're going to see. I'm going to go back to one other experience I had with ExecuJet. When we acquired ExecuJet, they were being sold simply because they were a distraction to ExecuJet's bigger sale of the operating company. Guess what, people? We're the distraction. Now, if you're the aircraft sales company and have other bolt-ons, like Ramsey just described, that's a little bit of a different story. QS Partners, Wheels Up, and others, and I can only presume it is just that. You're a little bit the stepchild. Let's call it what it is. So it's a harder and harder sell as you get along. So it's not for the weak of heart, and you do have to spend, one of the other questions was how long in advance do you need to be preparing? I mean, if you're not preparing now, you're behind, really.
Yeah, that's great. And this slide is for a sale to a third party. What we haven't talked about up here, and is kind of beyond the scope of today, is something done internally, right? So if you want to continue the legacy of your company, there can be a family transfer. It can be an ESOP where you transfer to your employees. You can do a recap. So there are internal ways to transfer the company as well, and that may apply more to the people in this room than finding that industry buyer where you're at right now, because right now nobody is at the scale and size unless there becomes this roll-up that was talked about to really attract that professional or that professional investor or that strategic buyer. So, okay, just final comments on with a minute left here. Number one thing, this will be a rapid fire. Number one thing somebody can do to best position themselves for a sale. Seth.
I think the number one thing to best position would be get your system together, right? If you you got to have the right people, you got to have the right data, you got to make sure that you have a system that someone would want to buy. And if you can do that and show success over a period of time so people can understand you're credible in what you're pitching, then I think you can get to the next step in actually having a conversation.
Chad?
You just have to have your pitch book ready. And your pitch book has to basically be your resume or your CV of how you took your company from 20 years ago to today and consolidate it and have a good qualitative and quantitative abbreviated example of what you can add to another company. It has to be a good pitch book.
Ramsey?
Plan. Engage a good legal team that knows what they're doing. Engage a strong financial team also to position you both on the legal side, as well as make your company look super lean and profitable on the financial side.
And I'll end with, know what you want. Be clear with yourself of what you want. So not everybody needs to lead to a sale. Some people get to the end and just shut it down, and they've achieved what they want to achieve. So getting clear on your own vision often it solves a lot of obstacles. So thanks everyone for having us on stage. Thanks to the panel. Appreciate you sharing. Have a great show.